Good afternoon, everyone. Welcome to the Monetary Policy Committee press briefing. And at the outset, I'd like to introduce Dr. Rashad Kasim, who is a new member of staff and a member of the Monetary Policy Committee. He is the head of our research department. So most welcome to you, Rashad, and thank you for being part of our team. Since the previous meeting of the Monetary Policy Committee, the risks to the outlook for domestic inflation have increased on the upside, mainly as a result of cost-push pressures. The domestic growth prognosis has improved, and the recovery is expected to be sustained, although not at rates sufficient to make appreciable inroads into the unemployment situation in South Africa. Household consumption expenditure has been the main driver of growth, whereas growth in fixed capital formation has remained weak. At this stage, there are no discernible inflationary pressures coming from the demand side of the economy. The global recovery seems to have remained on track, but the unresolved European sovereign debt crisis, rising international oil prices, partly as a result of geopolitical events and the tragic events in Japan, may moderate the pace of recovery in the near term. Global inflation risks have also increased, particularly in the emerging market economies, a number of which have tightened their monetary policy stances in recent months. The year-on-year inflation rate as measured by the Consumer Price Index for all urban areas measured 3.7% in January and February. Food price inflation, while still low, has been increasing. In February, it measured 3.5% and contributed 0.6% to the overall inflation outcome. On a month-on-month basis, food prices declined by 0.1%. Housing and utilities, primarily electricity, contributed 1.5 percentage points to the outcome. Petrol prices increased at a year-on-year rate of 12.3%, while administered prices, excluding petrol, increased by 9.1%. CPI inflation, excluding administered prices, was unchanged at 2.7%, while CPI inflation excluding food and petrol measured 3.4%. Year-on-year producer price inflation continued its recent downward trend in January when it measured 5.5%, compared with 5.8% in December 2010. Food price pressures remained relatively subdued in January, despite marked increases in global food prices. Manufactured food and agricultural prices increased by 1.5% and 0.5% respectively. This suggests that food price increases at the consumer price level may be moderated in the near term. The trajectory of the CPI forecast of the bank has changed somewhat since the previous meeting of the Monetary Policy Committee. Nevertheless, inflation is still expected to remain within the target range over the entire forecast period. Inflation is now expected to average 4.7% in 2011 and 5.7% in 2012. This represents an upward adjustment of approximately half a percentage point in both 2011 and 2012. Inflation is expected to peak at 5.8% in the first quarter of 2012 before declining to 5.6% in the fourth quarter. The upward adjustment is mainly due to revised assumptions regarding the international oil price over the forecast period. The survey conducted by Reuters also reflects a moderate upward adjustment in the inflation forecasts. In the February survey, the mean forecast of CPI inflation increased by 0.2 percentage points to 4.7 for 2011 and by 0.4 percentage points to 6% for 2012. Inflation expectations for 2013 remained more or less unchanged at around 5.7%. The break-even inflation rates have increased to above the 6% levels over the longer-term maturities. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the first quarter of 2011, also indicate a slight deterioration in the expectation of financial analysts. However, there was some improvement in the expectations of business executives and trade unionists. Inflation is now expected to average 5.3% in 2011 and 5.7% in 2012, compared with 5.5% and 6.2% in the previous survey. Inflation is expected to average 6% in 2013. While all categories of respondents expect inflation to remain within the target range in 2011 and 2012, business and trade union expectations average 6.2% in 2013, compared with 5.6% for financial analysts. The global economic recovery, although uneven, is expected to continue, led by a strong performance in global manufacturing. However, significant downside risks remain due to the confluence of shocks that have had the potential to stall the nascent recovery. These shocks include higher international oil prices, driven in part by events in North Africa and the Middle East, and the recent disasters in Japan, which could have a negative impact on the global manufacturing supply chain. The sovereign debt crisis in the euro area remains a concern, with CDS spreads signaling increased risks of sovereign debt defaults. The US outlook appears favorable, but the weak housing market and the ability of the economy to sustain growth once the fiscal stimuli dissipate during the year are some of the risks that persist. Growth in emerging markets remain robust, but Asian economies in particular may be negatively impacted by the recent developments in Japan. The global growth outlook may also be dependent on the extent to which the authorities in China manage to slow their economy down. The global inflation outlook has also deteriorated somewhat in the face of higher oil and food prices, although in some of the advanced economies there is a marked divergence between core and headline inflation. This reflects the relatively weak underlying demand conditions and the generally accommodative monetary policy in these countries. In the faster-growing emerging markets, inflation pressures are more pronounced and monetary policy tightening has become more widespread. The strong capital inflows to emerging markets that were a feature of most of 2010 have slowed down and in some instances reversed. South Africa has also experienced net sales of bonds since November, and in the year to date, net sales of bonds and equities by non-residents have amounted to 19.2 billion rand. Despite these net sales and the continued purchase of foreign exchange by the bank, the rand exchange rate has remained firm but volatile. The rand exchange rate is relatively unchanged since the previous meeting of the MPC, but has fluctuated between 6.80 Rand and 7.33 Rand per dollar per US dollar during this period. Part of the recent strength of the rand can be ascribed to US dollar weakness. During this period, the US dollar depreciated by almost 5% against the euro, despite rating downgrades in a number of euro area countries. Since the previous meeting, the rand has depreciated by over 3% against the euro and by about 1% on a trade-weighted basis. Domestic growth prospects appear to have improved moderately. Real gross domestic product grew by 2.8% in 2010 and at an annualized rate of 4.4% in the fourth quarter. The forecast of the bank has increased somewhat since the previous meeting of the MPC, with GDP now expected to average 3.7% and 3.9% in 2011 and 2012 respectively. These growth rates, while an improvement, are still too low to have a significant impact on the unemployment rate, which measured 24% in the fourth quarter of 2010. According to Statistics South Africa, formal non-agricultural employment increased by approximately 65,000 jobs in that quarter. The more favorable growth performance was driven mainly by the mining and manufacturing sectors. A number of high-frequency indicators suggest that the growth momentum will be sustained. The composite leading business cycle indicator has maintained its positive trend, and the Kagiso BER Purchasing Managers Index has remained above the neutral level since November 2010, suggesting a favorable outlook for the manufacturing sector. The physical volume of manufacturing production increased at a moderate year-on-year rate of 1.3% in January, but the 3-month-on-3-month rate increased by 2.8%. However, output levels are still below those achieved before the crisis, and the sector remains characterized by underutilized capacity. The utilization of production capacity increased from 79.2% in the third quarter of 2010 to 80.7% in the fourth quarter, compared with a pre-crisis average of around 85%. Output in the mining sector has maintained its general upward trend, notwithstanding the 1.9% month-on-month decline in January. Reflecting these developments, the RMB-BER Business Confidence Index increased significantly in the first quarter of 2011 to reach a level above neutral for the first time in 3 years. The building sector was the only sector in which negative sentiment was recorded. This is consistent with the quarter-on-quarter decline in the real value of new building plans passed in the fourth quarter of 2010 and the persistently low level of the FNB Civil Construction Index. The domestic growth prospects will also be dependent on developments in gross fixed capital formation, which declined by 3.7% in 2010 and made a negative contribution to GDP that year. In the fourth quarter of 2010, an annualized increase of 1.5% was recorded. Capital expenditure by public corporations increased by 3.3% in the fourth quarter of 2010, while private sector investment, which declined by 4.4% over the year, grew at an annualized rate of 1.6% in the same quarter. The relatively weak capital expenditure growth contributed to the decline in imports, which, along with improved commodity prices, allowed for a marked decline in the deficit on the current account of the balance of payments to 0.6% of GDP in the fourth quarter of 2010. However, should capital expenditure pick up, as envisaged by the public corporations, the current account deficit is likely to widen. Real final consumption expenditure by households increased by 5.1% in the final quarter of 2010, indicative of continued positive consumer sentiment and positive disposable income growth. This category of expenditure made the largest contribution, that is 2.8 percentage points, to growth in GDP during the year. There are indications that although consumption expenditure growth will remain relatively robust, it is unlikely to accelerate to excessive levels in the short term. The FNB-BER Consumer Confidence Index declined in the first quarter of 2011, but still remains at a relatively high level. This was consistent with the decline in confidence, albeit from high levels, evident amongst retailers in the Business Confidence Index and the retail trade sales growth in January, which was below market expectations. Expenditure on durable goods, in particular new motor vehicles, has been strong. Consumption expenditure is expected to be constrained to some extent by the continued high levels of household indebtedness, which declined marginally to 77.6% of disposable income in the fourth quarter, and the further increase in the number of consumers with impaired credit records since the implementation of the National Credit Act. The ratio of impaired advances to gross loans and advances of banks has remained relatively unchanged at around 5.8% for some time. Bank credit extension to the private sector has remained subdued. Total loans and advances by banks to the private sector have been growing at an annual rate of around 4% since September 2010, driven largely by mortgage loans and general loans, mainly to the household sector. Growth in mortgage advances, however, declined from 4.8% in November 2010 to 3.8% in January 2011, reflecting the subdued state of the property market. The various house price indices all indicate that house prices are either falling or increasing at very low nominal rates. This, combined with the recent decline in equity prices, may contribute to a moderation of the impact of wealth effects on consumption. The recent national government budget tabled before Parliament indicates a moderately looser fiscal policy stance through a slower pace of fiscal deficit reduction compared with that in the October 2010 medium-term budget policy statement. The fiscal deficit is now estimated to decline to 3.8% of GDP by 2013-14 fiscal year, compared with the 3.2% in the medium-term budget policy statement. The government debt-GDP ratio is expected to peak at 43.1% in 2013-14, which is much lower than the internationally acceptable norm of around 60%. High real wage settlements have been a significant upside risk to the inflation outlook. However, there are indications that nominal wage settlement rates may be moderating. According to Andrew Levy employment publications, the overall average wage settlement rate in collective bargaining agreements amounted to 8.2% in 2010, compared with a rate of 9.3% in 2009. Similarly, the downward trend in year-on-year growth in unit labor costs continued into the fourth quarter of 2010, when it measured 7.7% compared with 9.3% in the previous quarter. This positive trend, if continued, may contribute meaningfully to attaining an environment of low inflation and employment creation. The biggest risks to the inflation outlook remain food and administered prices, in particular oil prices. International oil prices had already accelerated in the latter part of 2010 in response to strong global demand, and this upward trend has been reinforced by the geopolitical events in North Africa and the Middle East, which have raised concerns about the security of oil supplies. Should these political issues be resolved soon, the underlying demand pressures are likely to still keep oil prices at relatively elevated levels. Since the previous meeting of the MPC, Brent crude oil prices have increased by almost $20 per barrel. Domestic petrol prices have increased by just under R1 per litre since January 2011, and a further upward adjustment is expected in April, in addition to the increased fuel levy. The MPC is of the view that the risks to the inflation outlook are on the upside. However, these risks and underlying pressures are mainly of a cost-push nature. In the light of the above, the MPC has decided to keep the repo rate unchanged at 5.5% per annum for the time being. Given the significant upside risks to the inflation outlook, the MPC will closely monitor any indications of second-round effects on inflation emanating from these cost pressures. Thank you. That's the end of the statement. We can open for any questions. And obviously, as is usual, the questions may be answered by myself, but also by any of my colleagues.
Governor,
Sorry, just to remind you to introduce yourselves.
Helmer Price, The New Age. Governor, in the quarterly bulletin, the box showed that the impact of a $10 per barrel rise in the oil price over 4 quarters was a 0.6 percentage point increase. We've had a $20 per barrel increase, but the MPC forecast has only been increased by 0.5%. Do you expect, therefore, the oil price to come back down?
What we expect is that at this point in time, I don't think anybody really knows what's going to happen to the oil price. We obviously have looked at, and in terms of our numbers, put in the numbers that we anticipate at this point in time. So it's within our forecast. We have put in increased numbers for oil, and this is the outcome of our forecast. Obviously, what we're saying is that this is a huge risk on the upside.
Governor, it's Renee Volgraaf from Business Times. How worried is the MPC about the volatility of the rand? Because it has been going up and down in the past few weeks.
Look, there are two issues about the currency. First of all is its level, and second of all is the volatility. In this period, the rand has certainly been the most volatile currency in the emerging markets. And it's of great concern. But again, it's what drives it that matters, and your ability to manage volatility has proved quite difficult. Again, it's a dollar story as much as it's a rand story, because if you looked at the trade-weighted index or you looked at the euro, you'd get a different story from if you're looking at simply at the dollar. So the volatility is certainly a factor that is of concern, but we can't ignore the fact that this is significantly a dollar story as well. In the end.
Governor, Nompumelelo Siziba from Summit TV. Just wanted to ask, given all the global pressures in terms of higher food prices and the oil price, is the Reserve Bank going to slow down its intervention in the currency markets?
I'm not sure what the one has to do with the other. The question
Sorry, can I just clarify? In December, you were quite active in buying up foreign currency, so I just wanted to find out whether is having a strong rand not such a bad thing at this stage, given higher global prices, which are going to affect us?
Obviously, a stronger rand mitigates against some of the increases in oil price or imported prices. But as we've said before, we do not target a level of the exchange rate. We are not targeting an exchange rate that should be stronger because of these reasons. Our approach to reserve accumulation is that it is something that we do, we have continued to do, we will continue to do as and when appropriate and as affordable. So the fact that you have these higher prices, if you look at the amount of interaction with the currency and the reserve accumulation, the numbers come out regularly, you'll see that the rand has moved, as I indicated earlier, it's been very volatile against the dollar, and that we have continued to accumulate reserves. It's not something, I think it would be wholly incorrect to say that we are not going to intervene and have a target of a stronger rand because of it mitigates against the possible inflationary pressures. We're very clear that we do not target a level of the rand and that the intervention is as part of building our reserves as and when appropriate. Yes, sir.
Governor Chris Bishop, CNBC Africa. Still with the oil story, you said in the last meeting that you were basing your inflation targeting on $90 a barrel. I'd just like to know, have you revised that figure upward, bearing in mind all that's happened in the last couple of months?
Yes, we have. It has moved up quite significantly in our forecasts, and as I said earlier and in the statement, we are looking at higher oil prices being factored in, and the models have given the results for the forecast going forward, but certainly we have factored in higher oil prices.
Would you give us a figure at all?
Look, the question of the oil price is moving all the time. So the question is we would do a number of scenarios and look at what there is. I think it's not necessarily the absolute amount of the price that we put in. Certainly it's higher. Yes, sir.
Governor Franz Wild from Bloomberg. Could you tell us whether there was any discussion about actually increasing the interest rate? And if so, could you say how many people were in favor of it at the MPC meeting?
No. When I say no, there were no people, it was not raised. I think that there was no discussion about either reducing or raising. And there was a unanimous view that at this point in time, recognizing the huge uncertainties that prevail globally at the moment, the appropriate measure in terms of our own conditions and taking account of these global pressures is to hold the rate steady for the time being. And it was a unanimous decision. Yes, sir.
Hi, Alistair from Business Day newspaper. I just wanted to ask you, because you said that gross fixed capital formation was, a major concern for the bank. Is that the biggest domestic concern that we face now beyond, aspects such as inflation to employment growth? Because, as you said, our GDP growth isn't really on track to create jobs, and it's a major concern, among the country, when we do start creating these wonderful jobs we want in the next 10 years.
Look, there are certainly a lot of issues that we face both globally and domestically, and we are highlighting that because at this level it does not enable growth to take reach the kind of levels that is appropriate. So it is very low and it is a factor of concern, and that's why we're raising it, certainly. To say it's the most important concern, no, I don't necessarily would say it's the most important, but it's certainly one that if we're looking at growth, we're looking at where we need to be, we certainly need to look at what is happening at that level, both from the government and from the private sector. Private sector was, as I said, negative 4.4 for the year, last year. Let me see if there's anyone who hasn't asked. All right. Renee?
Governor, I would like to know, there's still a vacancy for a deputy governor at the bank. Is there any indication of when that will be filled?
I think that is a matter for the presidency, and I'm sure when they're ready to attend to it, they will let you all know. Yes, sir.
Governor, coming back to the issue of a potential interest rate hike, the market has priced in an interest rate hike in the second half of the year. Could you tell us under what circumstances or under what conditions this might have to be, a potential hike may have to be brought forward?
Not at all. I'm saying very clearly at this point in time, the data on the table, and we're very clear that at the moment it will be, for us, appropriate to hold rates where they are. What you want to speculate with and what conditions there are, we watch the data and we will then look at the data and decide if it is appropriate to raise interest rates.
But if I may clarify, I mean, what would need
No, you're asking me to speculate with you, and I'm not willing to do that. You know,
Okay.
the market is taking its view and indicating when it thinks it's appropriate. The Monetary Policy Committee will look at the data and decide accordingly. The decision at this point in time is to hold the rates where they are for the time being. I'm not willing to speculate with you. Anyone else? Helma?
Governor, if we look at the demand side and the income side of GDP, we had 8.1% growth in demand side, and 9.3%, I think, in income side, and 8.9% annualized increase in the leading indicator in the quarter-on-quarter for January. Do you see this as sustainable, and if not, why not?
Who would like to take that one? Monday?
Well, we really do not make a forecast on the demand side of the economy. We usually do that from the production side, as the governor had mentioned, what the growth prospects would be from the GDP side. So what the demand side GDP is going to be, I really cannot speculate at that. I don't know.
Anyone want to add anything? You're fine? Any other questions? Yeah?
Just a last one, Governor, to ask you, just how concerned are you about administered prices going forward? Apparently, there's the prospect, not the prospect, but it's being talked about that we may have to pay even more for electricity to cover infrastructure maintenance costs. How concerned are you?
I saw that report in tabling before Parliament. We have factored in what we know is going to be the increase, which, if I recall, is 20% increase on this year, which was what was granted to Eskom to increase. And that's what we have put into our models. If there are other demands, I think that the nature of it, it's too speculative at this point in time, because even they look at it, how's it going to be financed, what is going to be done, is it necessary? I think that is a matter for the country to debate and decisions to be made around that. But certainly, we think that a 20% increase is already significant in terms of the costs. So I would not speculate on additional costs or what they may or may not be, because I think that is, at this point in time, discussion. What we are able to do is to account for that which has been approved, which is 20% increase for this year and next year. In terms of administered prices generally, as you can see, taking administered prices out of the equation, inflation in South Africa is below the lower band at 2.7. As we indicated, and you'll see the costs on administered prices, it is in the statement, and of course it's a concern. If you looked at the new growth path, part of the approach in the new growth path was that in order to have a better environment, a macroeconomic environment, one of the challenges would be to contain inflation, administered prices. That was in the new growth path, and we hope that that is looked at by government, because it's obviously something that they have to influence. But certainly administered prices are a factor and of concern.
Tsepo Moai, SABC Radio News. Governor, what message do you have for South Africans who are probably concerned and worried that maybe interest rates might go up sometimes in the future and they might battle paying their debts like the experience they've had a couple of years ago?
My message would be take advantage of the lower interest rate environment and get rid of debt as much as possible. You know, we've got to be a nation that begins to save. We've got to take the question of, there's no doubt at some point, interest rates don't only go down. They stabilize sometimes and they certainly go up sometimes. And if you look at what is happening in the globe, it has shifted into a concern about rising inflation. And South Africa will be no exception. So really the important message for every South African is, how do you minimize your debt? Take advantage of the lower interest rate environment at this point in time and try to be as healthy on your balance sheet as possible. Certainly don't splurge. Yes, sir.
Governor, how concerned are you with inflation at 3.7% that most of the wage negotiations, or at least the ones that I cover, still start with at least a 10% wage demand?
I think what we've indicated before, that obviously wages are important, what levels are set are important, but part of the challenge that what we've indicated from the numbers here is that there seems to be a downward trend, and wages will follow what happens with your inflation outlook. It's a lag question. So, as we indicated in the statement, if this trend was to continue, it's very healthy for the opportunities for growth, for employment, and so on. And it is a challenge for all of us to address our demands, and certainly if we want a better environment for growth, this is part and parcel of that. But we are seeing positive trends which we hope continue. Yes.
Stella Mapenza, also from Reuters News. Governor, you note in your statement that net sales of bonds and equities by non-South Africans have amounted to 19 billion so far this year. Is that something that you're worried about at the central bank? And what sort of impact do you see on the rand if this continues, if those sales continue?
I'm going to ask Daniel to respond, but perhaps just for a start, is that this has already happened in terms of the sales of just under 20 billion, and the rand is stronger against the dollar. So far, that has not impacted on the rand-dollar price. You're seeing some depreciation against the euro and a very small depreciation on a trade-weighted basis. So I'm not sure that there's this absolute link. Second of all, this is not unique to South Africa. This is something that a lot of the emerging markets are finding for varying reasons, that there is an outflow at this point in time. But perhaps, Daniel, you want to talk more in detail on that?
I think there's probably not much to add to that. The one point I would have made was that a possible concern would arise if this was a move which indicated that South Africa was being singled out in terms of a change in sentiment or a reassessment of what the prospects here would be. But as the Governor just said, this has been a generalized move that has reflected what is going on in terms of international investor sentiment. So it is not something that is unique to South Africa, but I don't think there's a lot more than one could add to that.
I think it's reflective of the uncertainty. I mean, the globe at this point in time is very uncertain, and this is part of a reflection of that. Helmo?
Governor, if I could also ask what's happened in terms of the uridashi market in Japan subsequent to the earthquake?
Daniel, do you want to do that?
I think the developments with regard to that market had been that over the last year or so, there have been unbalanced actual redemptions of uridashis, and we haven't seen any major change in behavior since the earthquake. And in fact, the actual exposures had been taken down quite a bit over the last year. I think in net redemptions in 2010 was something like 7 billion rands or so. So that had already happened. So there was nothing to give sort of new and further impetus that we'd have observed in recent weeks.
Any other questions? Any comments that anyone would like to make? You're fine? Then if that's that, thank you very much. Thanks for coming. Thanks for your questions. And we look forward to seeing you at the next meeting. Thank you very much indeed.